Most people think when it comes to property, you invest in buy-to-let, and that's it. They're your options. Well, it's not true. So this week on the Property Podcast, we look at alternative investments.
Yes, welcome to the Property Podcast. This is episode 216. I'm Rob D. Him, who you just heard, is Rob B. We are indeed talking about alternative investments. Just like property isn't the only asset class, buy-to-let isn't the only way to invest in property. We'll be running through a load of different potential investments, some of which you'll have heard of, some of which you might not, and giving you the pros and cons. There is no such thing as the perfect investment, of course, but there is such a thing as the right and the wrong investment for you. So we're going to be steering you through that particular minefield.
We are, and we've got your news story coming up as well. But before we do, we just have to thank Rob D for turning up after such a successful book launch. I mean, I was a bit nervous this morning, Rob, whether you'd come in or not. I thought you'd be jet-setting or signing copies in Waterstones. But no, you've managed to drag yourself in for another podcast. So I appreciate it, and I'm sure the listeners do too.
Yeah, well, I was just having breakfast with J.K. Rowling and John Grisham, and I noticed the time. I thought, well, I've got to go and do the podcast. I feel obliged, especially as the audience did such a wonderful job of supporting the book. Thank you so much to everybody who bought it in the first week. Launch days are always nervy. There's been so much leading up to it, and then you think, oh, is anyone actually going to buy it? But you did. Thank you very, very much. Really appreciate it. It was a fantastic day. And if you haven't bought it yet, it's not too late. Go over to Amazon, pick it up there. You can check out all the reviews. People seem to be enjoying it. And as we were saying last week, I think that this has got a lot of value. I think it's the kind of thing that people need to know about, especially amateur landlords. So if you know anyone who's not as obsessed with property to be listening to two guys chatting about it every week, but they've maybe got a house that they used to live in or they've inherited or something like that, point them towards this book. I think they might find it very useful indeed. And
I know what else you'll find useful are meetups. They are tonight. If you've not heard of our meetups before, what's going on? You need to get along to one. They're across the world. There's 40 of them, most of them in the UK. They're the first Thursday of every month. They're free, they're informal, they're fun, and they're full of friendly property investors. What more do you need? Go along to one, build your property network, and tell other people about them too. They're gaining in popularity month in, month out. They're super fun. Just go to thepropertyhub.net/meetup and you can find your closest meetup there. Grab yourself a free ticket and get along.
Yep, do it. And while you are there, people, I'm sure, will be talking about the election, which is what everyone seems to be talking about at the moment. And that links us into our news story. The story this week is from City AM. The title is, Here's What Experts Think the General Election Means for House Prices. And Rob, what do those experts think the general election means for house prices?
Well, I don't know how they've managed to carve a news story out of this, but they have. So fair play to the journo who's done a job here. But basically, I can read it out to you, but the window to the election is so short that nothing much will change. The property market hasn't got time to adjust because it's such a small window. So if anything happens, it won't be a lot. If anything happens afterwards, well, unless there's a big shock, it tends to be fairly positive after an election, but don't expect it to be suddenly surging to 20% growth because of somebody winning. So, not a lot really, Rob. Sorry, it's a bit of a non-story for our news story.
It is a bit of a non-story. There's very little in there, but hey, maybe that's no bad thing. And we will be talking about the election a little bit more as we come closer to it. When the manifestos are out, we'll probably do an episode talking about the housing part, if there's enough to say. If there isn't enough to say, then we'll just mention it as a news story. But safe to say, I don't think it's going to be the biggest issue of the election, but we are going to cover it nonetheless. All right, let's move on to our topic of the week, which is alternative ways to invest in property. So there's buy-to-let, there's buy-to-sell, there's other things like rent-to-rent, but we're not going to talk about those because that's not truly investment as such. But there's some others that you might not have heard of. So let's crack on with them. Rob, how about you kick us off with something that people I'm sure will have heard of, but might not know all that much about when it comes to property, and that is crowdfunding.
So crowdfunding, yes, you've probably seen this in some form or another. Maybe not in property, because it doesn't seem to have that much awareness yet. But basically, the concept of crowdfunding is you buy something or help launch something as a group, as a crowd. You put a little bit in, and a lot of people put a little bit in, and then in property, you can buy an asset. That's how it works. Then each of you who own that asset will get the return the property makes or the capital growth uplift or both. Depends what happens with that particular property. So it's a really interesting model. We've talked about this quite a long time ago, Rob, and I remember when it was really in its infancy and we kind of poo-pooed it a bit, but I've kind of maybe matured in my thinking on this. And I think from what we've talked about previously, I know you have too, because while it might not be for everyone, there is a place for some people. So let's have a look at the pros and cons. So what makes this attractive is that you can put just a little bit of money in. Property requires big sums of money. Most people have to work really hard to get those sums of money. Money doesn't come easily, so it takes a while to build those deposits and to invest in property. Crowdfunding, you can just put a few quid in, and start. There's not a huge amount of investment. Most people can get into it, which is a good thing. There's no time invested as well. Once you've made your decision and you've filled out the forms, that's it really. You don't have to then go around and manage the property. You don't have to speak to the tenants. You don't have to worry about maintenance issues. It's just done for you. So that will be attractive to people who kind of want the benefits of property and just want to be completely hands off. Now, we talk about how you can be hands off and invest traditionally, but this is the sort of the more extreme version where you are completely hands off. And of course, it's attractive for people who've got a lot of investments, people who like to diversify more. Maybe they've got stocks and shares and they're very hands off there, and they've got maybe gold or other assets, wherever their assets are, they've got a few, but property, they've never wanted to buy a full buy to let. They can just put maybe 5, 10, 15 grand into this and just see it the same way as they do their share portfolio. So there are things to be attracted by it. There are cons though. It's still quite a new system. It's still in its infancy. There are a few companies out there, but I don't think there's any company yet that has got a track record strong enough for us to endorse. You have to question then, who's picking these deals? So if there's not one company who's got that super strong track record that Rob and I would say, oh, you must check this particular company out, then who are the people picking those deals? Are they experts? Are they the right people? You don't know, and that's part of the problem. You can do your research, of course, but it's very difficult to know who's picking those deals because you can't go and meet them beforehand. One that most people forget is that it's not a market that's liquid. Once you've finished, you can't just sell up and then take your money out the next day. So you have to put your slice on the market and wait for the second-hand market to pick your slice up, and then on it goes. Now, that might be days, but it might be months. It might be longer. So that's one of the inefficiencies of this particular model. It's still not got all the benefits, say, investing in shares has. And of course, one of the big things we always talk about is the real learning in property happens when you invest. I don't think the learning would happen here because if it's so far removed. So if you want to learn about property investment and advance yourself as a property investor, this model probably isn't going to be right for you. So definitely a place for some people, but for those more enthusiasts of property, those who want to own the properties outright, probably not for them. So certainly a place for some, but not everyone.
Yeah, the thing that put me off this when we were talking about it before was the loss of control and the fact that it's bringing in like another source of risk. So you've got like what they call platform risk. In other words, like who is picking the deals and who's managing them? Are all your profits going to sort of disappear in management fees and things like that? That's what put me off. But the pros really are there as well. And I think it is an interesting market to keep an eye on. Not mature yet, like Rob said, but there's definitely going to be a place for it. And it'll be interesting to see what happens with that market. Now, there is another type of crowdfunding as well. And this is not an investment as such, but it's making a loan with property as the security. So it's a debt-based investment. Basically, you and other investors become the lender, like you might get a mortgage. But in this case, it's short term. It's like development finance. So people who are buying properties at auction or to do up and flip on, that kind of thing. You are lending to them so they can go and do what they want to do. So that is a form of crowdfunding, but a very different one. It comes with completely different characteristics. Now, this is what I've been doing a lot of recently through LendSwift. So if you've heard me talking about that on previous podcasts, it's exactly the same thing. But I'll give you a quick run through the pros and cons. The upside of it is that you get a fixed and knowable return whatever happens to property prices. So if you think about it, it's like when you take out a mortgage. You pay your lender a fixed amount. Whatever happens, if your property price booms or the market tanks, whatever happens, you're locked into paying that interest rate for a period of time. It's exactly the same thing here. So you as the investor don't have to worry too much about what's happening in the property market. You know that you're going to get this fixed return for a fixed period of time. It's also short term compared to other forms of property investment. So the loan itself is for normally up to a year. So this isn't like buying a property where you need to take sort of like a 5, 10 or more year view. It's not even like equity crowdfunding, which Rob was talking about, where there might be a particularly bad time where, okay, even though you could sell on the secondary market, it's just not the right time and you need to wait out the dip. And also, although it's a loan and you might be nervous about lending money to somebody else, you've got great security because you've got security over the property. Normally, you'll take other forms as well. But if it all goes wrong, you take the property back, you sell that to get your money back. So there are some real advantages to it. It's something that I'm keen on. It's something I've done a lot of. But of course, it's not perfect. It's not for everyone. The first one really is about working out whether it's a fit for you. So if the market grows, as I've already said, you don't benefit. You are the lender. You get a fixed return for a fixed period of time. Well, that's brilliant, but it means that you're not going to get this runaway growth. If the property market goes through an absolute boom, you're going to be no better off than you were. If the investor who borrows the money does something fantastic with it and really increases the value, they get the benefit of that, not you. So your return is fixed. That can be a good thing or a bad thing, depending on your point of view. Also, you really need to understand the technicalities to underwrite and secure the loan properly. In other words, should you be lending to this person on this project? And once you have done, do you have the security over the property if you need it? If you're not in a position to do that yourself, you need to be trusting a platform to do it. And of course, you need to trust that that platform is run by people who know what they're doing. So in that case, it's extremely similar to the other form of crowdfunding. So I think taken together, both of those are really interesting. Both pretty new, both very different, both not for everyone, but there's lots of interesting stuff in there that I think make both those markets worth keeping an eye on. But Rob, there are other forms of alternative investment as well, including, I can see what the next one is. I know it's one you're not keen on.
Hotel rooms.
Oh.
Yay. So what is a hotel room? You buy a room and it's managed for you. So the hotel is managed, or the service department, it often operates like a service department system, but it doesn't really matter how it's set up. Ultimately, your room is managed, it's let out by other people, and then you're given a return, often a fixed return. So if this works, then you've got, like we talked about before, an investment that's hands off. Fantastic. That, in some cases, will give you a guaranteed return. Now, you're probably thinking, Rob, what's wrong with that? That sounds interesting. Guaranteed return, hands off. Well, that's the problem. You probably heard me say if a few times in those sentences. And my real problem with this, well, actually, there's several, but I'll start with the first one, is often what's advertised isn't delivered. So these hotel rooms, they are offered a fixed return, but that's not paid out by their profits. It can be if it's done correctly, but often the way they can say you will get an 8%, 9%, 10% return for 2 or 3 years is because you're paying for it. They've priced it in. I've seen the model. I've been offered them so many times. I know exactly how it works. So those big returns that are guaranteed for a few years are priced into the product you're buying. So first of all, you're overpaying slightly. The next challenge comes that once that period runs out, what's the real return? And unfortunately, and I've heard it many, many times, the return you receive is far less than what was promised through the guaranteed return. And it's sold with this 8%, 9% return. But the reality after that period runs out, unfortunately, is much, much less. Now, they are hands-off. I'll give you that one. If they're well managed, and they're not always, so you have to look into who's managing the block, and we've talked about this before, so I won't go on about it anymore. But if they are well managed, then they are hands-off. But there are a few other cons. The resale market. Who's going to buy a hotel room off you? Not many people. There's not much of a resale market out there. The only people who buy a hotel room off you is other investors. So that market is smaller. But then most investors wouldn't touch a hotel room because you're not now selling it with the guaranteed rent and the glossy brochures and the slick sales guy who got you to buy it. So the chances of those investors investing are reduced dramatically again. So you've got a very small group of people who'd actually be willing to buy this off you. So the resale market is practically non-existent. Now, some of these companies say they'll resell it for you. How much effort they're going to put into that, I'm not too sure, because they've got their own ones to sell. And why are they so keen to sell it? And why do you see it everywhere, plastered all over the place? Well, it's because the commissions are so big. Now, I run an investment company called RMP Property. We could take these investments on. I've been offered them for years and years now, all different types of these investments. And the commissions are fantastic. There's no doubting it. But I like to sleep at night. It's quite important to me. And I would not sleep at night if I ever launched a project like this. So it's a big warning sign, people. If you see a company selling you a project like this, I would at the very least be skeptical, but my advice would probably be run away and run away fast.
Yeah, and you do see these companies, or you mysteriously end up on their mailing list somehow, despite not having signed up for it, where it's like, we'll sell hotel rooms and buy-to-lets, and we will manage projects for you, and do all these things. And they're selling all these different things. Like, can you really be experts in all these things? Or are you just selling anything that you get paid a fee for? Maybe that's just my skepticism, but I'm not sure it is. And I feel like we talk about this kind of thing a lot. We talk about guaranteed rent and what it really means and all that sort of thing. We talk about it a lot, but I think we need to, because we still get asked questions about it. And it's one of those things that's very aggressively marketed. You do come across it all the time. So don't just listen to us, make your own decision. But I think having it there as a counterbalance is really important. And Rob, there is another form of investment as well that I know you're particularly keen on, similar in its characteristics in many ways, student pods.
Yeah, so for those who aren't aware of sarcasm, I'm not particularly keen on these investments. I'm not going to go on anywhere near as much. I won't go on a rant. I've talked about student pods in the past, and actually they're called student investments or student pods. They're given all different types of names, but actually if you Google student pods, there's a Telegraph article that I was quoted in years ago where I was unhappy with them then. So you can read that, but basically the principle is the same of hotel rooms. No resale market, high commissions, guaranteed rent, questionable, hands off if it works. I've heard of a few cases where people have managed to get in and get out and not be burnt, but I've never heard anybody rave about them. I've never heard anybody say, I've had this great success story about student pods. So, one to avoid again. But go and Google student pods. They've rebranded them now because I think student pods got such a bad name and just called student investments or student hall investments, as they used to be called student pods. But if you Google student pods, there's enough bad news there to probably make you never look at it again. But Rob, we've had a couple of alternative investments to probably avoid there, but one to certainly just have on your radar and at least know that exists is the ground rents.
Yeah, they were a couple of clear no's. Ground rents is a definite maybe, depending on the circumstances. It's a thing that not a lot of people are going to know about. Did you know that you can buy ground rents? I knew that you could, but I didn't actually know that much about it before researching this episode. So what is a ground rent, first of all? Well, when you've got a leasehold building, so normally flats, sometimes houses, but you've got something leasehold, so you, when you buy it, are the leaseholder rather than the freeholder. The freeholder has the right to collect ground rents, so they'll charge you a certain amount per year, and you as an investor can buy a portfolio of ground rents. So maybe it's just for a particular building. Sometimes you get them pooled, and so you see a portfolio across multiple buildings. So that, of course, gives you the rights to the income stream from those ground rents. Whenever somebody pays up, that income goes to you. So that's what it is. What are the advantages of that type of investment? Well, the first advantage is a pretty steady yield. So the yield on ground rents tends to be about 5%. So that means that you're paying round about 20 times the annual income that the ground rents would generate. And of course, you know what the income's going to be because you know exactly what the ground rent is. It's in the lease. So the yields tend to be about 5%. So if the investment stacks up in other ways, then compared to leaving it in the bank, pretty good. There's also the possibility of extra income as well. So if someone wants to extend their lease, then there's extra money to be made there. You can charge them for the lease extension. If the lease gives you the right to manage the block as well, then you can get income from block management activities as well. And if in the lease, the freeholder, that would be you, needs to insure the building, then you can get commission from the insurer when you arrange that as well. And then the cost of the insurance itself gets recharged to the leaseholders. So there seem to be some big advantages in there. You get this 5% yield, and there's also these potential extra income streams as well. But if it was perfect, everyone would be doing it, and they're not. So what's wrong with it? Well, the big one for many listeners of this podcast will be that you can't get a mortgage to buy a ground rent. So that yield is there, but you can't get the higher leveraged ROI because you can't get a mortgage. Also, it does involve some work. So it's hands-off compared to some forms of investment, but it still does involve you doing something. You need to chase up those ground rent payments, and you need to be able to take legal action if they're not paid. Otherwise, of course, if no one's paying up, you don't get your return. And that return that you do get will be eroded by inflation over time unless the lease has a increase clause in there. So if there's a clause saying that it doubles every 10 years or it goes up by a certain amount every year, then fine. But otherwise, if not, if the ground rent is static, then that will be eaten away at by inflation. And of course, I mentioned the fact that you need to do some work. You need to chase up payments. You might need to take legal action if a particular leaseholder isn't paying. Well, that means that you'll need to have some kind of expertise. You'll need to be able to read a lease and know what it all means. You'll need to understand the legalities of what you do if someone doesn't pay. You need to understand the legalities of lease extensions when things like that come up. So this isn't a complete, just like buy it, forget about it, done. You need to really do your research, and you need to be willing to do the work it's involved. It's a very different type of work from other property investments, but there is work in there.
Well, because Rob's done his work and he's researched this topic, you've got some tips, haven't you, Rob? I like this.
I have. So I'll give you a few and then the big ones at the end. So first thing to do, check the length of the leases. So if you're offered something or you see these offered at auction, which is very common, you often see these coming up at auction, then how do you know if it's a good buy or not? Well, first thing, check the length of the leases. The shorter the leases are, the better. Now that might sound a bit backwards because this is something that you're buying and you think, well, maybe you should be the longer the better, like it is when you're buying a flat. No, the shorter the better, because then the more likely it is that your leaseholders are going to want to extend it. And that means more revenue for you. Also check the ground rent. Does it escalate every 10 years, 25 years, whatever it is? If there's escalation in there, then all the better, because that means that your future income is going to be all the higher when that staircasing kicks in. Also look at whether the lease allows you to arrange insurance, because that's an extra income stream, as I mentioned. And does it allow you to provide block management? Because again, that's something else you can make money from. So that will all impact on your total return. And then also, this is where you'd really need the expertise. Are there any onerous lease clauses? Is there anything in there that you have to do? So there could be a provision saying that in the event of major works, the freeholder has to advance the money and claim it back later. You don't want to be doing that. This is where you really need to know what you're doing, because I don't know if you've ever tried to read a lease, but it's practically impossible if you ask me. I know a little bit about property, but it's just written in these enormous paragraphs with no punctuation and words where you just don't know what it means. I was looking at one once just trying to figure out like which part of the ceiling falls under the common parts and which part is yours, and just trying to get to grips with that is impossible. So it's tough if you don't know this stuff, and that's why the biggest tip of all for this is to work with an expert. There are brokers who specialize in buying and selling ground rents. So it might not be something you've come across before, but it is an established form of investment. There are experts out there. Make sure, as with any type of the investments that we've talked about, you work with an expert you trust. The less you know yourself, the more you need to be able to trust the person you're working with. And I think for ground rents, if you are not an expert in this stuff, that's going to be critical in whether it's a good experience or a not so good experience.
So alternative investments, lots covered there. But we've looked at this previously with Pete Matthew, where we've looked at funds and collective investments, so kind of the more formal stuff that you might expect. So this is an extension almost of that episode, looking at some of the other things you can invest in. That episode is episode 189, but we'll link to all the show notes of this episode and that particular episode at the following URL, which is thepropertyhub.net/alternative investments. So go to thepropertyhub.net/alternative investments, where you can find all the links this week. Alternative investments. Should you invest? Should you do it? it's not going to be a definite yes or no for many people. I think this will give you the platform now to go and research it a little bit further. Maybe you're doing traditional buy-to-let and it's working for you and you've got a model that's great. Well, crack on. But it's good to know what's out there. It's good to be aware of it, particularly if you've got newbies coming up to you, if you're more experienced and they say, oh, they've seen this type of thing. Point them in the direction of this podcast or recite a bit of what's been covered today and help them out.
And something that really helps us out is iTunes reviews. We love a good iTunes review. We read one out every single week. And are we going to make an exception this week? No, of course we're not. Rob, what have we got?
We've got a lovely review from Andy. Thank you, Andy. And Andy says, I only have a fairly small portfolio, which to be fair, ticks along quite nicely. I hadn't bought anything for nearly 5 years. To be honest, that was it until I started listening to your brilliant, inspirational podcast. It reignited the enthusiasm when I first started getting involved in property. I had a nice bit of equity sat in each of them, and having listened to you, I decided to be a bit creative and put my assets to good use. I've bought the commercial block where I've been renting, and it's quite a big deal for me, having 2 large retail units and the potential for turning the first floor into residential. I honestly believe listening to you guys on a weekly basis has given me the drive to grow that portfolio. So thank you, Rob and Rob, for giving your listeners the confidence and guidance to make things happen. Well, Andy, that is superb. Congratulations to you for taking action. I love it when people take action. I love reviews like that. They're awesome, aren't they, Rob?
That is just fantastic. Thank you, Andy. That is brilliant. Lovely to hear. Thank you for leaving us a review. If you haven't left us one yet, go on. Go and do it. Make today the day. But before you do, stick around and listen to our resource of the week, because this is a good one. It came in from Matt B in Dubai, who sent this one in to us. Thank you, Matt. This is an iPhone app called Measure Your Land, which is useful for looking at development opportunities. So Matt says what you do is it brings up Google Earth, which you've probably seen before. So you get an aerial view of the plot that you're looking at. And then all you do is you tap to mark out the edges, and then it will automatically tell you the area of the plot straight away. So you can see how that's really useful. If there's a potential plot that you've spotted that you think might be good, but you need to know what the size is, that is an instant way of finding out on your phone without having to dig out the tape measure. So thank you for that, Matt. That's fantastic. It's called Measure Your Land, and we're going to be linking over to that in the show notes this week, which are at thepropertyhub.net/alternative investments.
Thanks, Matt. That's an awesome app. That's really super cool. It never ceases to amaze me, all these apps that are launched and are brought out. You think there can't be anything else that's cool related to property. And then someone brings something like this out. So cheers, Matt. Appreciate it. And hello to our Dubai listeners. And hopefully we can attract a few more listeners to our episode next week, because I think it's going to be a really popular one. And it's one of those impactful ones where we say this every now and again. We don't say it every week. Next week's going to be really popular. But I think next week will be. We're going to look at the UK property boom that you're missing. Now, bit sensational title, but trust me, you need to hear what we're going to talk about next week. This isn't fluff. This is real stuff that we're seeing that, in a way, because of what we do, we're really privileged to access this type of information and our networks. We see things sometimes that aren't out there for the public. I won't say too much more, but all I will say is make sure you're on next week's podcast and you download it on the Thursday and possibly pass it around to your property investor friends. It's one of those episodes that people will need to hear.
Big claim. But I think you're right. It is one of those things that you just don't see in the press, but it is happening and it's very interesting indeed. So that is coming up next week. Ask Rob and Rob will be on Tuesday as ever. And tonight are meetups. So if you haven't booked your place yet, get over to thepropertyhub.net/meetups. And if you are going, have a wonderful evening. I'm sure you will. So enjoy all that. Have a great week. We'll see you back here next Thursday. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.